you've got so many stocks and ETFs now. There's more ETFs than stocks to choose from. You've got so many to choose from. So you've got to start somewhere. How do you narrow that down? And this is where we might differ in the way that we narrow it down, but a lot of times you find a lot of overlap with that. So maybe walk us through your kind of process of your funnel. So you're starting with about 6,000 stocks. And so what's your first cut?
So we're starting with the same database as Market Search, which is an incredible source of information. In full disclosure, we do use Market Search. We love it. So we start there, and we have about 6,000 or so U.S. traded companies, and that includes ADRs. That includes different ways to get overseas as well. So from there, this is where our proprietary $1 trillion comes in. And the hard part is, you can try to get the scope of how big the universe is, but the US markets, if you include ETFs and hedge funds and ETFs and everything, it's around 30 plus to $40 trillion. If you include the international markets, you're close to 50. So we're a trillion, but the buying month after month is big enough where it does impact the float. So
Mm-hmm.
we are able to pretty much chop that by 90% and go from 6,000 down to 600 stocks, which is what they're holding and what they're buying. And
Right.
anything that they're cutting, bye-bye. And now we have a little bit of a focus list. Now that's still way too much, and we don't enjoy FOMO, and we don't want to be staring at things all day long. So in step number three, so step one is the universe. Step two is what are these specific billion-dollar funds going after? Step number three is we're specifically looking for buying, specifically larger buying. We tend to
Mm-hmm.
go back 2 months, which gets us to collectively, if you include, since on retrieval, about 3 months of information there. So 2 months of buying. We're looking for earnings growth, typically above 10%. That will get you names like that are maybe slower growers. Think that'll get a Walmart in there. That will
Mm-hmm.
get a Philip Morris in there. It won't get things like a Coca-Cola in there. And for some people that's right, but for us, we are looking for more growth. And then we're doing
Well,
additional
and why wouldn't it get Coca-Cola, for instance, just to kind
uh,
of show that
sim-
contrast?
simply earnings growth is low single digits typically. So
Just too
unless you're in,
lackluster.
it's one of those things where if you look back and you're up, I mean, don't get me wrong, if you're up 50%, you're thrilled. But the question is, how many years did it take you to get there?
Right, right,
Um,
yeah.
and how
Are you
much
getting that 50% in 1 year or 10?
yeah, and it very likely could happen in 10 plus. And we know it's not as you're not buying it at the same price point that Warren Buffett got in.
Hmm.
So it's just a different business, significantly more mature. And what are they doing now? They're all buying the smaller, slightly less sugar-filled sodas to grow. And is that what you really want? Or do you want to just go own those companies if they're publicly traded that are growing really fast that Coke and Pepsi are trying to acquire?
Hmm.
And then finally, we do look at performance, and we're also looking at relative strength.
Yeah, and just one question, and this is definitely very applicable to right now. You just had this kind of very sharp correction. I mean, the velocity with which we came down, I mean, it was kind of kind of crashy, and because it came down so quickly, and like like the COVID crash, it was very V-shaped in the recovery. There was certainly, at least I thought we were going to see another leg down, and that didn't materialize. We kind of really snapped back very sharply, and so if you're kind of looking at data, we had the follow through day on April 22nd. If you're looking at data that's maybe from the end of April, was that enough time to kind of show that shift, or do you expect, oh, it's really going to be next month that we really see where that money started moving? Because you could imagine that there was a lot of wringing of hands, a lot of uncertainty, a lot of like, oh, maybe we need to get into the more defensive things. You certainly saw the staples doing a lot better there for a while. But now if we're looking at end of April, how quickly do you start saying, oh, okay, this is where the institutions are really putting their bets now?
That's an excellent question. And I would say that me and my small but mighty team, we were expecting drastic changes in April, and we really didn't totally see it. And what I
Hmm.
mean by that is they were, so April 7th was the absolute low on this V-shaped bounce. And we were expecting, because I mean, that's pretty early in the month where we would have expected maybe, okay, well, the rhetoric went from tightening to spending. And to the next bill, then the next, are we going to lower interest rates? And the whole kind of theme changed. But if I had to kind of look through what these funds are typically doing, and I'm going point to point, month after month, not throughout the whole, I don't know what day they bought, but I know that they point to point, what was the share difference in accumulation. But what was interesting to me, I saw what I would call more of a barbell strategy, where they tend to be more growth at a reasonable price type managers. These men
Right.
and women tend to go to the similar business schools. So there's some names that were showing up that I was interested by, like, okay, well, why are they buying slower growth names like a CVS or a Starbucks that we haven't really looked at in years? And then on the other side, we're seeing the names that are really at the helm of the IBD 50, which would be like Robinhood and what would be another good like Cloudflare. So these would be names that are. So I saw the barbell. So my assumption is that at the end of this month, when we get the data from May, I would assume it's going to be a little bit maybe potentially changed, because really what I saw was I can look at like the 93 tickers that I'm focusing my time on, and then that whittles it down. But if I kind of look at it, it was spread. But if I go to the top tranche of who's doing the best, the leading industry groups clearly was software.
Right.
And software overlaps in the market surge data between tech and communication services. So a lot of it was software, and a lot of it was industrials. And they were still pushing the market in the direction that the market went.